Hello, and welcome to episode 11
of Mo Money,
the investing show for millennials by a millennial. I'm teaching you how to be rich later, right now. 11 episodes in, and let me tell you what, just keeps getting better and better. As always, let's start the episode off with a Mo Money
market update.
Now, I'm sure by now you've all heard of the Panama Papers. Comprehensive compiling some of the world's wealthiest people, corporations, and trusts who are using Panama and other countries as a tax haven.
Big surprise.
In a related and uncoincidental occurrence, this week the big allergen Pfizer deal was struck down by the U.S. Treasury, who I suppose just now finally noticed that Pfizer and other corporations have been leaving the USA to shelter their revenues in country with lower tax rates. This practice is known as corporate inversions. Second, it's been anything but a boring week in this market. After almost a 2-month rally, the market finally pulled back just a bit this week, sliding about 1.5% off of Friday's highs. The market had a strong day on Wednesday after Fed released notes from their meeting stating that an April interest rate hike was discussed but ultimately voted against it, which sent the market rallying higher for the day. But the market was quickly sent back in the other direction on fears of global growth slowing, which brings us to this week's topic. Now, let me start off by saying the United States of America is the greatest country in history. Yeah, we've done some stupid shit, some awful shit, but we continue to be the best place on earth for those who want to come work and make something of themselves and improve their lives. Some people may call this type of thinking ethnocentric, and I may tell those people to shut the fuck up. Other countries may have their good parts to them, sure, but we're still the best. Now, with that said, the United States is not slipping. We are not losing our influence, and we are not losing our power. But other countries are starting to catch up with us. The old farts who grew up in the 50s and 60s, who talk about how great America was back then basically choose to conveniently forget that America was basically cheating by calling themselves the best. How? Well, most of Europe at the time had spent the last 20 years bombing and killing each other. Japan was basically reduced to rubble, and the good old USA was basically untouched. It was like the USA had entered the boxing ring in the last round, after Mike Tyson and Muhammad Ali had just spent the past 11 rounds unmercilessly beating the crap out of an infant. We made everything here. Cars, technology, whatever. It was all made here. But then, lo and behold, other countries started to rebuild, repopulate.
Who'd have thunk it?
And with that came the growth of the global economy. Countries reduced to rubble were now starting to rumble. Trade began, ports were open, jobs were shipped off in search of cheaper labor. Now, this was bound to happen. There was nothing the USA could really do to have stopped all this, except, hypothetically, start a World War III. But that probably would not have turned out too well. The point being, this is not the United States of the early 1900s, where we wanted nothing to do with the rest of the world, wanted everybody to just leave us alone. We are fully ingrained. We are the focal point in this global economy. Now, you may say, great, that's awesome. Why should I care? The reason you should care is because whether you like it or not, things going on globally will have a great impact on the stocks you own and the stock market in general. Like I said in Mo Money episode 9, macro news has a real effect on the price movement of a stock. Now, just this past week, we heard from JP Morgan CEO Jamie Dimon, arguably one of the greatest, most influential, and most competent CEOs in the business world today. In his annual letter to shareholders, Dimon addressed and confirmed the global growth worries. Now, as a well-conditioned American, at this point, you may have the impulsive reaction of, fuck up! USA! USA! Now, Dimon's comments paired with Yellen saying the Fed backed off from a rate hike in April because of their concerns of the global growth. Now a market only paying attention to Yellen long enough to hear her say no hike started to really listen to her reasons, and the worries have shifted from rate hikes to global growth concern. How much does the global economy really affect American companies? Well, let's start with the European Union, United States' largest trading partner. Recently, there have been concerns of a few EU members defaulting on their debt, including Spain, Italy, but most recently and most notably has been Greece. Now, I know what you're thinking. Who cares about Greece? I know you're thinking they've been irrelevant for the past 2,000 years. Haven't done anything but make gyros and own diners and make stupid movies about fat people and weddings. But here's why they do matter. Okay, although their GDP is very low, they are a part of the EU. EU banks do own a lot of their national debt. So if Greece defaults and decides that they cannot pay their loans, then the EU banks holding the debt are left holding the bag. And if Greece defaults, who's to say Spain, Italy, and Ireland won't soon follow? But still, why does this matter to you, the USA, and the USA stocks? Well, because if the EU banks are left holding the bag, then they're forced to tighten up funds and reduce lending. When lending is reduced, companies will find themselves struggling to find capital to start and grow their businesses. And when they can't start or grow their businesses, then the economy suffers. And when the economy suffers, every participant within the economy suffers. These countries bring in less imports, people spend less money, growth comes to a grinding halt. US companies either have a large presence in Europe or seek to grow their businesses there. And if the soil has no liquidity, companies will be unable to grow. Now, let's jump to one of the countries that financial news outlets love to freak out about. China, the second largest economy in the world, and the United States' second largest trading partner. China, over the past few years, has had a roaring and quickly growing economy. But people have feared a slowdown for years now, and it seems like now those people may truly have a case. So what does a slowdown in China mean for you? Well, if you don't own stocks, then it probably doesn't really mean much. But if you do, it could mean a temporary world of hurt. China being one of the largest economies in the world, so many companies seek to enter their ports carrying their goods in hopes of expansion to a whole new market. And of course, with a whole new market means a whole new country full of revenue. And more revenue means a higher stock price for shareholders. So let's say you own a construction stock such as Caterpillar. The Chinese economy slows down and stops building. Construction stocks could get hurt as well. Also, commodities such as steel and aluminum could see their prices fall as demand decreases. Or say you own a consumer stock. China's slowdown could equal less jobs, meaning less income to spend on goods such as Nike shoes, or trips to fancy restaurants such as Pizza Hut or KFC. Or say you own a tech company like Facebook or Google. Communists are not very friendly with this open type of technology. Companies like this have trouble finding any type of traction in countries like China. China, although slowly opening up to outside markets, is still a communist country. And for that reason, what they say and the information they present is still hard to believe or take at face value. The way you can really gauge the way the Chinese economy is doing, instead of listening to what the leaders say and the statistics that they present, is by looking at American stock and how their revenue is performing within these countries. This is why I never suggest making investments in Chinese stocks unless you're looking to really speculate. Final global concern is the Middle East. Okay, now I'm nowhere near an expert in Middle Eastern culture, but I have to call a spade a spade. And the spades that run those Middle Eastern countries seem not mentally competent to be running a country. They seem like small children. They all seem like little Tom Pettys, Richard Pettys, pettywops. They're petty and they're irrational. The reason for the extreme drop in oil has been Middle Eastern countries like Saudi Arabia refusing to stop producing oil. To stop producing oil would spell the end of the country. Then you have American oil tycoons like T. Boone Pickens, one of the most respected oil tycoons who I love, talk shit about Drake in the most epic way. You have him calling for $60, $80, $100 oil by year end. It's like they don't take into consideration the irrationality of those Middle Eastern leaders. That's why I would suggest staying away from most energy stocks based solely on the fact that you're investing your hard-earned money on these psychos acting rationally. Bottom line, okay, it is no longer us against the world. It is us and the world. We grow together, we slow together, we go together, like traffic and weather, like Rama Lama Lama, Kadingity Ding Da Dong, like Martin and Gina, like diamonds and forever. The United States still remains to be the center of the financial universe, but instead of being surrounded by little tiny stars, countries have become larger shining stars orbiting us. It is important to have at least general knowledge of the world. I feel millennials understand the importance of being a global citizen. And if you do that, maybe you won't be able to become a global investor, but you will be able to become a smarter, more prepared investor. Now, I wish I could sit here all day and go through every country and tell you why or why not you should not worry about them. I ain't got that kind of time. So you're gonna have to do a little bit of your own homework. But till then, USA. I'll see you next week for another exciting episode. Make sure to like, comment, subscribe, share, follow me on Twitter, like me on Facebook.
Mo Money signing out.